Profit. I have with me Mr. N. Kamakodi, MD and CEO at City Union Bank. I'm Harsh Saita. First off, Mr. Kamakodi, the street enthused with regard to at least your growth numbers. 5% both sides of the balance sheet, advances as well as deposits. Just talk to us about what gives you the confidence in the current environment to go out and lend. You've done very, very well in this quarter where growth is concerned. And can that stay at that 4 to 5% sequential kind of run rate?
Over a decade or so, we had a consistent track record of about 15 to 17% growth rate of our book. But post-COVID, we had, let's say, a few years when the growth rate was actually lower compared to our earlier track record. So in that, actually things started once again from the January when we could see the growth coming quarter after quarter, when for the June quarter it crossed 10% and now it is in the range of 12%. And our entire growth has purely come from our traditional areas of strength like the MSME, the commercial trading activities, agriculture and gold loan. Even though we have expressed our desire to start the retail, probably like say the preparatory works are underway, and whatever growth we have achieved now is purely from our conventional areas, and new areas of growth whatever we have identified are yet to give their let's say contribution for the growth. So the track record whatever we have seen, and also we started the exercise with the consultation of Boston Consulting Group to start the digital lending activities, where the decision making for the proposals less than 1.5 crore are being taken by the let's say system almost to 70 to 80%. And that has also started improving the TAT, and it has started improving the capacity to handle things, which has helped us to take things to the next level. So we feel before the end of the current year, we should be, let's say, touching the industry level growth is what we expect at this point of time.
Okay, so by end of this year, roughly teens kind of growth, is that what one can expect? Maybe 13, 14% for full year FY25?
Yeah, we refrain from giving any exact number, but what I can definitely say is that it will be touching the expected industry level growth before the end of the current year.
Okay, and with regard to margins, they've held up in an otherwise difficult environment when it comes to margins. Talk to us about what's happening. Are you doing higher yielding kind of lending, or what's helping your margins in this environment?
See, basically, like we had given our expectations that, like say, the margins will be at 3.6% plus or minus 10 basis point, and we are very well within that. Whatever expectations we shared with the market in the earlier quarters. Basically, like there were last year when the like say the rate of interest was increasing, like say we couldn't pass on certain like say rate hikes, which like say in fact had a certain impact last year. But this year, like say, since the decreasing interest rate scenario got delayed by like say a few months, if not few quarters, that has helped us to stabilize our net interest margin. Particularly, we are able to have a better bargaining power in the new businesses we are booking to.
Okay, and do you believe credit costs have now peaked? You're past the cycle when it comes to credit costs. Your provisions number is half of what it was same time last year for first half of this year.
Yeah, basically, if you had a chance to look into the past strength, year before last, we had about 1,200 crore plus slippage, which moderated to about around 1,000 crores for the last financial year. And this year, we expect it will further come down by about, like say, come down by 200 crore to about 800 crore. And also, you may also find that the total recoveries, the recoveries from the live NPA accounts and the technically written off accounts are much ahead of the incremental slippages, which has helped us in seeing the reduced margin, provisions, and also the gross and net NPA numbers coming down in the successive quarters.
And do you therefore, what is it that you believe will be the kind of provisions credit cost number for this year in your opinion for FY25?
See, we don't normally go by such an estimate, but what we clearly say is that since the recovery numbers are more than the slippage numbers, incrementally the reversed provision will itself take care of the incremental provision requirements, and whatever extra provisions you make, that depends upon what is the targeted net NPA we would like to have, and these sort of decisions we will take it on an ongoing basis. So the point what that needs to be understood is that like the slippage numbers have come lower than the total recoveries from both live and technically written off NPAs put together, because over 90% of our, maybe even 95+ percentage of our total loan book is fully secured with to greater extent with the immovable collateral, and our recoveries from the NPA account percentage and all are like say we are able to recover about around 70 to 80% of the slippage amount at the portfolio level. So the incremental the recoveries, since they are more than the additions, we are very safe in that.
Got your point. And when does ROA therefore start to inch up? Do you believe this is that year where you'll see an inch up with regard to ROAs? Where do you exit FY25? What kind of an ROA number?
We had for multiple decades, we had our average return on assets around 1.5% plus or minus, and we are back at that level after 2 to 3 years of COVID impact, and that ROA numbers are very well stabilized, and we should be able to have this ROA level, current ROA level is what we expect.
Okay, and do you believe that FY26 you'll grow faster than the system?
We are working for that, and since we expect some amount of incremental growth contribution will come from the new areas like secured retail and which we are planning to start, probably our growth rate we can definitely aspire and see getting more than about the industry level is what the visibility we are having currently now.
Okay, so that turnaround visible. With regard to your NPA ratios, you said that at least your provisioning for this year will largely be zero except the adjustments to net NPA. So what's the kind of GNPA and NPA targets broadly that you have? I'm sure that there's likely going to be internal discussions even going forward, but broadly what are those aspirational numbers that you will be looking at?
We hope on the current trend, we should be closing the current financial year between 1 and 1.25%, 1 to 1.25% net NPA is what we expect at the current point of time.
Understood. So another maybe 0.5-ish% kind of reduction or 50 bips reduction with regard to where net NPAs is concerned. Is that fair to expect?
Yeah, from the current level of 1.62, you have 37 bips will take you to 1.25%, and more reduction will probably get you somewhere. The minimum reduction has to be like say the 37 bips.
Okay, 37 bips minimum. Okay, and with regard to your loan book, I believe largely secured, so you're not seeing any fresh delinquencies, no stress from unsecured?
We don't have much unsecured, like all our core business to greater extent is through the secured book, and that is because of that, consistently we have higher recoveries from the slippages.
Right, and could you give us that component, the mix for secured versus unsecured in your book?
Yeah, like say the almost 95% plus percentage of our loan book is secured.
Understood. And therefore, from the unsecured side of things, are you seeing absolutely any pressure?
So far, no.
Understood. Okay. And asset quality, you believe even through this cycle will hold up? You're seeing some bit of stress in the system as a whole. You're not seeing it on your balance sheet yet. You are expecting that that will not reverse for you, right?
Yeah, fortunately, like say, when post-COVID, when the cycle started, you had, like say, a significant increase in the loan book of the banking sector came from the unsecured retail credit. We were not in that segment at all. Because of that, okay, we had to, like say, face a certain amount of reduced growth. But nevertheless, when the tide turns on the opposite side, we are relatively safe. And since we don't have much unsecured portion, particularly the consumption type retail, right from the beginning, our focus had been in the funding for the, like say, I mean, mainly secured portfolio and funding for the creation of business assets, which had taken us so far. And in this asset quality issues in the unsecured front, we don't have much to complain about.
Got it. And with regard to your deposit side, what's the kind of growth number you would expect or aspire for? You have a healthy loan to deposit, I don't deny that, but you don't want it to get too far ahead as well. So how are you playing that? How are you playing things on the deposit side?
That's right. Like say, we feel and we continuously work that the deposits will not be a constraint for the credit growth, whatever we try to achieve. Is what we have as the rule, and we are going ahead with that focus.
Right. And what's helping you hold on to cost of deposits? Because it's not gone up substantially. It's gone up by maybe 20, 30 bips over the last year or so. Do you believe all the repricing is done for you, or do you believe some bit of repricing still in the pipeline?
To greater extent, the repricing is over. And as you are expecting the, like say, you have reached the fag end of the increasing interest rate cycle, and only the time of beginning of the decreasing interest rate cycle is getting debated. We think we are perhaps almost reached the like say peak level of the deposit cost for it.
Right, and of course, you've alluded to the fact that we are likely going to see rate cuts going forward. Impact of that on your margins, if any, or you see a very marginal impact on your numbers on the back, if that were to translate?
Definitely, you will see when the interest rate increases, there will be expansion in margin, and when the interest rate decreases, there will be like say some amount of impact. But one thing what you have to keep in mind is that if the rate of decrease in the like say interest rate is slow and steady, probably that impact will not be like say fast. So the both the yield on advances and cost of deposits will match. So we hope the decrease in the rate of like say the rate of rate cuts, when they happen, if they happen in a slow and steady fashion, by and large, the incremental impact on the margin should be minimal.
Okay, Mr. Kamakodi, great getting perspective. Thank you so much for coming in, speaking with us.